Hello everybody, in today's video we will be studying the chapter 13 Accounting and Finance Functions Within Business of ACCA Business and Technology. Before watching this video, I would request you all to watch the previous video so that you'll be able to understand this chapter better, the playlist of which is given in the description box below. Accounting and finance functions within business. So in this chapter we will be learning about the finance functions and procedures, the accounting functions in every business organization, and what are the financial statements and etc. So what is accounting? Accounting is the systematic recording, reporting, and analysis of financial transactions within a business. In larger organizations, the range of the tasks that the accounting functions need to perform is very wide. This often means that the accounts department is split into a number of different functions, each of which deals with a separate set of responsibilities. So don't look at this flowchart right now because you'll not be able to understand anything. We'll just straight away learn from the theory part, and then it's going to be easier for you to understand the flowcharts. So for this exam, we need to be aware of the three key functions within the accounts department. So the first thing is the financial accounting function, and then we have the management accounting function, and then the treasury function. So these are the three functions which we'll be studying in this chapter. So to begin with, let's see what the financial accounting function is. So as we have seen in the previous chapter, the financial accounting is concerned with the production of the annual financial statements in accordance with the relevant accounting standards and legislation. So what were the financial statements? We saw the statement of P&L and the statement of position, which is the balance sheet. Whenever a business transaction takes place, such as sale, purchase, or payment of an expense, there is a need to record these transactions in the organization's accounting record. So before everything, the first step is to record the transactions in the books of primary entry. So what are the books of prime entry? So let's first see what the book of prime entry are. So there are 5 main types of books of prime entry. So the purchase day book, the sales day book, the cash book, the petty cash book, and the journal. What are these? These are the 5 prime entry books. So the purchases day book, so it is used to record the purchases made by a business, listing the invoices received from suppliers. So when we purchase something, they send us an invoice, right? So we record that. The sales day book is used to record the sales made by a business, listing the invoices issued to customers, the invoices we have sent. The cash book is used to record the receipts into and the payments out of the organization's bank account. So whatever cash comes in, we record in the cash book. Whatever cash goes out, that also we record. What is the petty cash book? Okay, so in an organization there are various petty things, like something which is not related to the business's daily routine activities, like very tiny activities. Like if I have an organization, a business organization, if let's say I have a real estate organization, I buy and sell houses. If a customer comes and I show them the plans of the houses and I give them coffee to drink, right? That's not my routine business, but I still have to pay for the coffee, right? So those kind of petty expenses are known as petty cash book, are known as petty expenses, and they are recorded in the petty cash book. The petty cash book is used to record sundry small payments of cash made by a business. Example, purchasing tea and biscuits for staff, refreshments, or reimbursing the travel expenses of job interviewees. So for my employees, I give them tea and biscuits every day, so even that is a petty expense. The journal. A journal is used to keep a proper record of non-routine accounting adjustments made by senior account staff. So there are some of non-routine. Non-routine means something which is not like as such related to the business. Non-routine adjustments. So these adjustments which are made by the senior account staff, those are recorded in the journal. So what are the books of prime entry? The purchase book, the sales book, the cash book, the petty cash book, and the journal. On a regular basis, often daily or weekly, depending on the volume of transactions, the day books are totaled and these totals are entered into the ledger accounts. So after entering into the books of prime entry, the next step is to balance them at the end of the week or end of the daily, and then we put the balances and these totals are entered into the ledger accounts. At the end of the accounting year of the business, the balance is calculated on each ledger account, and these balances are used to create the financial statement of the organizations for the period. These are the main financial statements produced by most businesses each year. Okay, so just give it a read. I'm giving you 30 seconds. So, what are the three financial statements which are produced by the most businesses? The most important ones are the statements of P&L, statement of financial position, and there's another one which is statement of cash flow. So, statement of cash flow basically shows the inflow and the outflow of the cash throughout the accounting year. So, let's see what statement of profit and loss, also known as the profit and loss account or the income statement. So, what is the income statement? Income statement is the statement of profit and loss, which is also known as the profit and loss account for the year. So, the statement of P&L shows the income as well as the costs which were incurred in the period. This allows the business to calculate whether it has made a profit. If the income exceeds the costs, then obviously the business has made a profit, and it makes a loss if the costs are more than the income. So income statement is known as the P&L account. So what is the statement of financial position? As we have seen in the earlier chapter, that the statement of financial position means balance sheet, and this shows the assets, the business resources such as motor vehicles, buildings and cash, and liabilities, money which we owe to the third parties of the business. This statement, the statement of financial position, also shows the stake that the owners of the businesses have in the organizations or their capital. In a company, this is often referred to as shareholders' equity. Shareholders' equity is the amount of capital which has been invested in the business by the shareholders. And the third financial statement we have is the statement of cash flows for the year. This summarizes the cash receipts and the cash payments for the year. This helps to show whether the company is solvent. Solvent means having sufficient cash, and where the cash has been spent in the year. So, solvent is when if we have sufficient cash. In summary, the sequence of the steps in the accounting function is: first, we have the transactions. We write the transactions in the day books. After the day books, we put it into ledger accounts, and then we make the financial statements. Noah has been asked to find 4 pieces of information about FGH Limited for his manager from the company's statement of P&L and the statement of financial position. He is asked to find these. Which of the following correctly match the information with the financial statement each would be found in? So we need the ratio of the current assets to current liability. So where is the current assets and current liability found? It is found in the balance sheet. So what is a balance sheet? Statement of financial position. Okay. Total shareholders equity. Shareholders equity or capital, where is it found? This is also found in the statement of financial position. Gross profit as per percentage of turnover, profit and loss account. So what is that? Statement of profit and loss account. Right? Total rent paid over the year. So the total rent which we have paid over the year, even that is found in the statement of P&L, because it comes under one of the costs which has been incurred. So the answer is SOFP, SOFP, SOPL, SOPL A. Hope that's clear. So why do businesses need to prepare financial statement? So preparation of these financial statements is very expensive, and at the same time it is very time consuming. But still most organizations have an accounting function. So what is the reason? So the main reason is to satisfy groups of people who have an interest in the financial performance of the business. So there are various stakeholders who are interested to know the financial performance of the business, and that is the reason why we need to make financial statements. So how could the stakeholders use this information? Let's see that. So, and why we need to prepare them. So the first thing is owners. So why would the owners care about the financial statements? So the owners are interested to know how much profit the business has earned and how profitable it is and how well it is being run. They'll see that in order to invest in it, right? And then we have the managers, so interested in the company's financial situation so they can plan effectively for the future. Then we have banks. So banks want to see the business and they want to see the business's performance, so that they have to check ki should we provide them loan or no, will they be able to repay us or no, to check that. How are the employees interested? So employees are interested so that they can see what impact it will have on their jobs and on their wages. And then we have suppliers and customers. So suppliers may wish to check the financial stability of the business to ensure it will be able to make payments, supply goods as needed. Government may wish to check the business is obeying relevant laws on reporting and taxation. So companies must send a copy of their financial statements to each of their shareholders at the end of the year. Large and publicly quoted companies are also required to appoint external auditors each year to give an independent opinion whether the financial statements have been drawn up properly and whether they give it to an fair value. So bigger companies must have to have an external auditor. Moving on, we come to integrated reporting. So what is integrated reporting? So many organizations adopt an integrated reporting approach. It means that their financial statements cover the organization's financial performance and position using the three primary financial statements as mentioned earlier, but also report on any other relevant information that would be of interest to the users. So, integrated reporting is when the financial performance, financial position, as well as any other relevant information, everything is combined together and shown across in the financial statement. So, what does the other relevant information mean? So, it might mean the major risks the organization faces. So, those statements must include what risks they're facing and how any actions they have taken to deal with it. Then they have the organization's performance regarding ethics and corporate social responsibility, organization's performance with regard to sustainable development. So, ethics and corporate governance, corporate social responsibility, sustainable development, and the actions and risks they have taken. So, integrated reporting and capital. With integrated reporting, instead of having environmental and social issues reported in a separate section of the annual report, a standalone sustainability report, the idea is that one report should be made and it should capture the strategic and operational actions of management in its holistic approach to business and stakeholder well being. So, the management accountant must be able to collaborate with top management in the integration of financial well being with community and stakeholder well being. So, there should be a holistic view of everything. Integrated reporting will bring statutory reporting closer to the management accountant and will make management accountants even more important in bridging the gap between stakeholders and the company report. So, management accountants are important in bridging the gap which is between the stakeholders and the company's report. So, the management accountant will be expected to produce information. So, what information is expected from the management accountant? So, they have to see that the information, there is a balance between quantitative and qualitative information. It has to link the past, present, and the future performance. It should consider the regulatory impacts on performance and it should provide an analysis of factors that could impact the future. So it has to check if there's a balance between qualitative and quantitative information. It should link the past, present, and the future performance. It should it should consider the regulatory impacts, and it should also provide an analysis of factors which can impact or affect the future situations. There there is clearly a need for the profession to accept the challenge for being the mechanism for a new type of transparency and accountability, one that incorporates social and environmental impacts as well as economic ones. So the role of management accounting in sustainability is not that well established as of now, but it is anticipated that over the time passes, integrated reporting will become the corporate reporting norm. This will offer a productive and rewarding future, but not only for the management accountant but for the society as a whole. So, there are six types of capital. Let us see what the six types of capital are. The integrated reporting framework recognizes the importance of looking at financial and sustainability performance in an integrated way, one that emphasizes the relationship between what it identifies as the six capitals. So, the first capital we're going to study is financial capital. So, what is financial capital? Financial capital is what we traditionally think of capital. What comes to your mind when you think of capital? Money, right? So, that is the financial capital. Example, shares, bonds, or banknotes. It enables the other types of capital described below to be owned and traded. So, financial capital includes the shares, bonds, bank, state bank, notes, etc. The second one is manufactured capital. So this is the form of capital that can be described as that can be described as comprising of material goods or fixed assets which contribute to the production process rather than being the output itself. Example, the tools, machines and buildings. So the assets, the things which the material which are required in the production process, they are known as the manufactured capital. So like tools and like buildings and machinery, etc. Now we have the intellectual capital. So what is intellectual capital? This form of capital can be described as the value of a company's organization's employee knowledge, business training, and any proprietary information that may provide the company with a competitive advantage. So intellectual capital is basically the something which we cannot see, which is intellectual, like the knowledge of the employees or the business trainings, and all of that comes under the intellectual capital. The fourth one is the human capital. So this can be described as consisting of people's health, people's knowledge, people's skills, people's motivation. All these things are needed for productive work. Then we have social and responsibility capital. So this can be described as being concerned with the institutions that help maintain and develop human capital in partnerships with others, families, communities, business, trade unions, schools, and voluntary organizations. So, social and responsibility capital. These are concerned with the institutions that help to maintain and to develop the capital. So, like families, communities, businesses, trade unions, schools, and all of these come under the social and relationship capital. And now we have natural capital. So, this is the last capital. So, this can be described as any stock or flow of energy and material within the environment that produces goods and services. It includes resources of a renewable and non renewable materials. The fundamental assumption of the integrated reporting framework is that each of these types of capital, whether internal, external, tangible, intangible, represents a potential source of value that must be managed for the long run in order to deliver sustainable value creation. So, natural capital is just anything which we take from the environment, right? Energy or anything which we take from the environment around us. So, what are the six types of capitals which we've seen? Financial capital, manufactured capital, intellectual capital, human capital, social and relationship capital, and natural capital. Moving on, we have what is IIRC, the International Integrated Reporting Council. So, what is IIRC? The IIRC was formed in August 2010 and it aims to create a globally accepted framework for a process that results in communication by an organization about value creation over time. So, IIRC seeks to secure the adoption of integrated reporting framework, an alternative to the recommendations by the GRI by report papers. So, the framework set out several guiding principles and content elements. So, IIRC, International Integrated Reporting Council, has a framework, and the framework has some guiding principles and content elements as well that have to be considered when preparing an integrated report. So, guiding principles and content elements. So, let us see what the guiding principles are. So, the first guiding principle is strategic focus and future orientation. So, the report should provide an insight into the organization's strategy, and how it relates to the organization's ability to create value in the short, medium, and long term. So, the first thing is strategic focus and future orientation, and linking it with the present and the past as well as the future tense. And then we have connectivity of the information. So, the report should allow a holistic picture of the combination, and it should show a form of interrelatedness and dependencies between the factors that affect the organization's ability to create value over time. So the first principle was that strategic focus and future orientation, and the second one is connectivity of the information. The third one is the stakeholder relationships. So what is a stakeholder relationship? The report should provide an insight into the nature and quality of the organization's relationships with its stakeholders. So the report should provide the relationship of the stakeholders and the nature and quality of those relationships. Materiality. So the report should disclose information about matters that substantively affect the organization's ability to create value. So the report should have information about matters that affect the organization's ability to create value. And then we have conciseness. So the report should be concise and include only the relevant information and data. Reliability and completeness. So the report should include all material matters, both positive and negative, in a balanced and without any material error. Reliability and completeness. So then we have consistency and comparability. So the report should be consistent and we should be able to compare it over time. So these are the seven guiding principles given by the IIRC, International Integrated Reporting Council. So the first one is strategic focus and future orientation. And then we saw the connectedness or the connectivity of information. Then it should also have the stakeholder relationships, materiality, conciseness, reliability and completeness, and consistency and comparability. Now let's see what the content elements are. So there are 8 content elements. So the first content element is organizational overview and external environment. So what does the organization do and what are the circumstances under which it operates? Next is governance. How does the organization's governance structure support its ability to create value in the short, medium, and long term? And then we have business model. What is the organization's business model? And then we have risks and opportunities. What are the opportunities and what are the risks of the organization? Strategy and resource allocation. How are we allocating the resources and what is the strategy which we're following? Performance. So what has been the performance outlook? What challenges and uncertainty is the organization likely to encounter? And what are the implications for future performance? Basis of preparation and presentation. How the organization determine what matters to include in the integrated report and are such matters quantified or evaluated? So what are the content elements? Firstly, we need organizational overview and external environment. Then we have governance, business model, risks and opportunities, strategy and resource allocation, performance, outlook, and basis of preparation and presentation. So these are the content elements, and these are the guiding principles. Management accounting. What is management accounting? So, management accounting is carried out to assist management in discharging their duties to plan, direct, and control the operations of the business. It is concerned with the process of measuring, analyzing, and interpreting and communicating information to management in a form which is easy for them to understand. So, management accountants will use the financial accounting records as a source of data for their work, but they may choose to use any other sources as well, both internal and external, that they feel will be useful for the managers. Well, there are no legally required formats for management accounts. There are several key management reports that are common to many businesses. So, 3 of the most common are cost schedules, budgets, and variance reports. So, what are the 3 which are common to all the management accounting departments in almost all organizations? Preparing budget, preparing cost schedules, and preparing variance reports. We'll see what they mean. So, what is a cost schedule? A cost schedule lists the various expenses involved in manufacturing units of a product. Various expenses which are involved in the manufacturing units of a product. This is often shown as a list of the costs incurred when making a unit of each of type of the product we make. This may be called a standard cost card. So cost schedule is also called as a standard cost card. Let us see the illustration. ABC Limited manufactures toys. One of the products is a wooden train set, which has the following standard costs per unit. So this is a cost card, standard cost card, or this is a cost schedule, seeing what all we really need. There are several key business decisions that this cost schedule can help a business to make. So how can the cost schedule help? So it can help in knowing what the pricing decisions are. How much should we sell our products for in order to ensure we make a profit? And then break even analysis. Which products are profitable and which are loss making? Is a new product worth producing? Can we sell enough units to cover the cost of making the product? Then we have key factor analysis. Should products be made in-house or should we outsource it? Which one is cheaper? Which one is a better option? Investment appraisal. Should we buy a new machine or are the existing assets enough? So what are the factors that cost schedule can help with? Pricing decisions, how much we need to price. Then break even analysis, are we getting a profit or a loss? Key factor analysis, where do we get the raw materials from? Investment appraisal, do we have to buy anything more? These are the 4 things which we get to know from cost schedule or standard cost card. Now we have budget. What is a budget? In addition, once the costs per unit have been identified, it should be possible to produce a budget. So a budget shows the total planned revenues and costs for our business for the coming period. So something which we forecast, something which is planned. It is based on the cost schedule which we have mentioned earlier. So budgets are useful for several reasons. There is a acronym for budgets which we need to understand, which is CRUMPET. So just remember what is CRUMPET. C for coordination, R for responsibility, U for utilization, M for motivation, P for planning, E for evaluation, and T for telling. So let's see what comes under budget. Coordination. So the budget provides guidance for the managers and ensures that they are all working together for the good of the company. Then we have responsibility. So the budget authorizes managers to make expenditure, hire staff, generally follow the plans laid out in the budget. Then we have utilization. So budgets, especially cash budgets, help the managers to get the best out of their business resources. So it is utilization of the resources. Moving on, we have motivation. The budget can be a useful device for influencing the behavior of managers and motivating them to perform in line with the business objectives. And then planning. Budgets force the managers to look ahead so we can find out opportunities, threats, etc. and take action. And then we have evaluation. So budgets are often used as the basis for the management appraisal. The manager has performed well if he has met his budgets in the period. What is telling? Telling is also known as communication. So budgets ensure that all the members of the business understand what is expected from them during the coming period. So one major drawback of budgets is that they are only estimates of what will happen in the coming period. So in reality, most businesses will not perfectly achieve the targets which they have set in the budgets. So they'll have to prepare a variance report. So we'll see what variance report is later in the next section. But first, let's just revise what you've learned in budget. So we know that budget is basically a forecast or a planning, and it shows the total planned revenues and cost of our business. So there is CRUMPET. C is the coordination, R is the responsibility, U is the utilization, M is the motivation, P is planning, E is evaluation, T is telling. Now let's come to variance reports. What is a variance report? A variance report compares the budget to the actual results achieved for the budget period and identifies any significant differences or variances between the two. So a variance report compares the budget to the actual results. and we'll see what are the differences between the actual results and the um, actual results and the budget which we had set. So, for control purposes, management may need to establish why a particular variance has occurred. Once the reason has been established, a decision can be taken as to what, if any, control measures might be appropriate to. So, to prevent adverse variances from occurring again in the future, to repeat a favorable variance, or bring the actual results back on course to achieve the budgeted targets. Moving on to management accounting and business policy and performance. So, in addition, the management accounting function has a particularly important role in formulating, implementing, and controlling the business policy and performance. So, for example, a business may have an objective to grow its revenue and profits. It will then need to examine possible ways of achieving this, right? Such as by the launch of new products or acquisition of a competitor. Finally, it will have to assess which of these approaches will achieve its goals and select the best ones. So, the accounting function can clearly contribute to this process. Since the achievement of an organization's plan is usually measured in monetary terms, accountants are needed to help establish objectives and then evaluate the various possible strategies to identify which are the most financially attractive. So, once a strategy has been selected, such as the launch of a new product, the business must carefully monitor and control it to ensure that it is being implemented properly and performing as desired. This is usually done by undertaking various variance analysis, which we have done in the earlier section. So, now let's see what are the differences between financial accounting and management accounting. I'm sure this is very easy because we've done both of them, but let's just see what are the differences. So, why is the information mainly produced? So, let's do from financial then management. So, we know that financial accounting, we saw that it's mainly for the government, for the creditors, for the shareholders, for the banks, right? So, it is basically for external use. And coming to management accounting, it is for the internal use, for the managers and the employees. What is the purpose of information? So, financial accounting is used to record the financial performance in a period and then the financial position at the end of the period. And the management accounting is to aid planning, controlling, and decision making. So, are there legal requirements for financial accounting? Yes, limited companies must produce financial accounts, and management accounting is not really legally required, but people still do so. So, what are the formats? So, we know that financial accounts must follow a certain format and content and follow accounting standards and company law. But management accounting, management decides on the information that they require and most useful way of presenting it. So, how to present it? What is the nature of information? So, the financial accounting, the nature is only financial, and in management, it is financial also and non financial as well. So, time period, the time period of the financial accounting is mainly a historical record because we record the previous, what happened in the previous year, whereas the time period of management accounting is historical as well, but it is even forward looking. Hope that's clear. Moving on. Test your understanding too. Consider the following two statements regarding the management account function. So, variance analysis enables the business to identify why the actual financial results were different to those predicted by the budget. That's true. Management accounts follow a set predetermined format. No, that is of the financial account. So, the answer is A, one only. The functions of the Treasury. So, now let's see what are the functions of the Treasury. So, the Treasury management is the corporate handling of all financial matters, the generation of external and internal funds for business, the management of currencies and cash flows, and the complex strategies, policies, and procedures of corporate finance. So, what does the Treasury do? A Treasury handles the financial matters, it handles the cash flows, it handles the foreign currency, and also it generates the internal and external funds. So, what are the key roles of the Treasury and finance functions? So, the first and the key role of the Treasury is working capital management. So, the Treasury section will monitor the organization's cash balance and working capital to ensure that it never ever runs out of money. And then it also does cash management. So, what is cash management? Preparation of cash budgets, and arrangements of overdrafts where necessary. And then we have financing. So the Treasury section will monitor the organization's investments and borrowings to ensure that the gain as much as the investment income as possible and incur as little interest expense as possible. And then it also takes care of the foreign currency. So the Treasury section will monitor foreign exchange rates and try to manage the organization's affairs so that it minimizes the losses due to the changes in the foreign exchange rates. And then we have tax. The Treasury section will try to manage the organization's affairs to legally avoid as much tax as possible. So it will try to manage the organization's affair to legally avoid how much tax possible. So what are the key roles of the Treasury? So they maintain the working capital, cash management, financing, foreign currency, and tax. Hope that's clear. So foreign currency. So I'll just explain what foreign currency is. So the value of the dollars and the value of the currencies keeps changing by day to day. So the rate of the foreign currency keeps changing and that affects the business organization. So the treasury takes care of the foreign currency. Now we come to management of working capital. So working capital is the capital available for conducting the day-to-day operations of an organization, calculated as the excess of the current assets over current liability. So current assets minus current liability gives you working capital. Remember this throughout. Current assets minus current liability gives you working capital. So as we are seeing in the numerical, inventory, trade receivables, cash, these are current assets. So this is the total current assets. We are going to minus the trade payables, which is the current liability. So the working capital balance is this. Okay. The treasury and finance function is responsible for deciding on an appropriate level of investment in working capital for the business. There are advantages in holding either large or small balances of each component of working capital. So there's a there are various advantages and disadvantages of the amount of working capital we have. So advantage of large balance. Let's first see the large balance. What happens when our inventory is large? What is the advantage of that? So customers are very happy because everything is in stock and whenever they require the goods will be provided. What happens when the advantages or what happens when the trade receivables are large? So what are trade receivables? Trade receivables are the money which we will be getting from someone. Trade payables are something which is the money we need to pay. So when trade receivables has a large balance, so customers are happy. Why? Because they're happy to buy things on credit. Cash. So what happens when advantages of what happens when cash is large? So creditors are also happy because bills can be paid promptly. And trade payables. So what are the advantages? We are happy because we don't have to pay right now. What is an advantage of having a small balance of inventory? So low holding costs. So the cost of holding the stuff is low and there is less risk and because goods don't get damaged. What is the advantage of having a small balance of trade receivables? So there is less risk of irrecoverable debts. So there is no problem ki someone will not pay the money because the balance is low. So there is less risk of irrecoverable debts. Good for cash flow. What happens when our cash flow is less? Cash balance is less. So it's good because the more cash we had, we can invest it somewhere and get returns on it. Okay, trade payables. So what happens when our trade payables has a small balance? So the suppliers are happy and they might offer discounts. Hope that's clear. Management must decide on the appropriate balance to be struck for each component. Conservative managers will have a policy of holding a large working capital balance, while aggressive management will hold a low working capital balance. Which of the following is a consequence of aggressive management policy? So, aggressive management will have a low working capital balance. So, current assets minus current liabilities. So, low working capital balance. So, what happens when there is a low working capital balance? Keeping a low level of receivables means that the money collected is collected promptly, decreasing the chance of bad debts. Low receivables would also mean that we are offering less credit to customers. which they may find unattractive. Low levels of inventory mean that the customer is less exposed to the inventory obsolescence, but it does not mean that the company may run out of inventory if demand is unexpectedly high. So the answer is less increased risk of inventory outages. Evaluating and obtaining finance. The organization may need additional funding to allow it to grow and invest in new projects. It may therefore need to raise finance from external sources. So, there are two types in which we can raise finance. The first one is debt. So, this involves borrowing cash from a third party and promising to repay them at a later date. So, normally the company will also have to pay interest on the amount they have taken loan on. There are various sources of debt that an organization can raise funds from, including bank loans, overdrafts, venture capitalists, through selling bonds or debentures. So, what are the advantages of debt? What are the advantages of raising capital through debt finance? So, the interest payments are allowable against tax. So, the interest payments are tax deductible. So, whereas the shareholder, the dividends we pay to the shares, that is not tax deductible. So, debt is tax deductible. Raising debt finance does not change the ownership of the organization. So, when we raise the money through equity, more and more owners come because we take it from shareholders, so they become the owners. Whereas in debt, just because we borrow money from somebody, they don't become the owner, right? Debt tends to be cheaper to service than equity as it is often secured against the assets of the company and takes priority over equity in the event of when business is being liquidated. When business is being liquidated, interest payments for the loans and loan payments are done before paying the shareholders. And debts are also cheaper than equity. Equity. Equity involves selling a stake in the business in order to raise cash. For companies, this involves selling shares to either new or existing shareholders. So, what are the advantages of raising money through equity? There is no minimum level of dividend that must be paid to shareholders. So, in case we're not having profit, we don't even have to pay dividends to the shareholders. A bank will normally require security on company's assets before it will offer a loan. So, when you take a loan from a company, when a business organization or even an individual, when I take a loan from the company, they take collateral from me. Collateral is mortgage. Like I keep my home, I give my house as a mortgage, right? So there's no such situation in equity. Generally, the treasury and finance function will weigh up which source of finances best suits the circumstance of the business. So, who decides which source of finance is the best? The treasury decides. AHG PLC needs to raise 50 million to launch a new product. AHG hopes that new product will be a success, but the returns are highly uncertain. So, it can also be a failure. The product is expected to sell for around 5 years. AHG is currently trying to decide whether the launch should be financed using a 5-year bank loan or through raising equity. So, as it is very risky, we should avoid debt because if we have debt, it is a compulsory payment. But equity, we don't even have to pay if we lose, right? Because the investors themselves invested here. So, the answer is B. AHG should choose equity. Determining business tax liabilities. So, one of the roles of the finance and treasury function is to calculate the business tax liability for the organization and mitigate or reduce that liability as far as possible within the law. So, what is tax avoidance? Tax avoidance is the legal use of the rules of the tax regime to one's own advantage. So, it is legally done, like we just avoid the situations where we need to pay the tax in order to reduce the amount of tax payable by means that are within the law. What is tax evasion? Tax evasion is illegal, it is a criminal offense. Tax evasion is used of illegal means to reduce one's tax liability, for example, by deliberating misrepresenting the true state of your affairs to the tax authorities. The directors of a company have a duty to their shareholders to maximize the post tax profits that are available for distribution as dividends to the shareholders. Thus, they have a duty to arrange the company's affairs to avoid taxes as far as possible. However, dishonest reporting to the tax authorities, example declaring less income than actually earned, would be tax evasion and a criminal offense. Okay, so while the traditional distinction between tax avoidance and tax evasion is fairly clear, recently authorities have introduced the idea of tax mitigation. So, tax mitigation means the conduct that reduces tax liabilities without frustrating the intentions of Parliament, while tax avoidance is used to describe schemes while they are legal are designed to defeat the intentions of the Parliament. So, tax mitigation does not um, affect the intention of the Parliament, whereas tax avoidance affects the Parliament's motive. I hope that's clear. Tax avoidance, the traditional view of neutral. Okay, just read this, pause and read. It is very easy. That's it, we're done with the chapter. Let's just do the practice questions. Emma is recording a non routine business transaction. Which book must she use? Non routine transaction in the journal. An analyst wishes to use a company's financial statements to determine whether the business has a significant cash balance or not. So, what will it use? It will use the financial position because there are assets value may there will be cash balance and statement of cash flows. So the answer is 2 and 3 only. Which of the following is not typically prepared by the management accounting? Budgets, investment appraisal, variance reports, business tax calculation is done by the Treasury. The following statements relate to either management or financial accounting. Format decided by management. Which of the following relate to management accounting? So, if the management decides the format, it is management accounting. Created to aid planning and decision making, that is also management accounting. Legally required, that is financial accounting. Mainly for the use of external stakeholders, that is also financial. K Limited is looking to raise additional finance to enable it to open a new store. Which of the following are the advantages of K Limited raising finance via debt? So, what are the advantages of debt? Interest payments can usually be delayed. That's not true. Debt is often considered to be a better source of finance if the return from the project is uncertain. That's not true. Debt finance tends to have a higher annual cost than equity. That's not true. Debt holders are paid before equity holders in the event of the company being liquidated. That is true. Tax dash is a legal misinterpretation. So, illegal is always tax evasion, and tax dash is simply the legal use of tax legislation to minimize the amount of paid tax paid by the business. So, it is legally used, it is avoidance. Which of the following responsibilities would normally be dealt with by the Treasury function? Break-even analysis, costing of products, production of financial statement, foreign exchange management. Obviously D, foreign exchange management. So that's it, we're done with this chapter. This was a very easy chapter. I hope it's clear. There's a playlist in the description box below. Check it out for the other videos. Thank you.